Well, those are the headlines that we'll be tracking for you all day today on ET Now. Let's introduce our very first guest for today. We have with us Dilshad Billimoria. She's the founder and chief financial planner with Delzer Consultancies Private Limited. Dilshad, thank you so much for joining us today on the show. I hope you and your family are keeping safe amidst these tough times. And yeah, tough times indeed, because as the cases have mounted and how with more than 1 lakh cases, 1.25 lakh cases, in fact, in just 24 hours, I guess it's a little unsurprising that the government is once again considering a lockdown, because that seems to be the one way to tackle this virus, apart from, of course, all of us getting vaccinated. So how should one prep themselves, especially from a financial perspective? You know, phase 1 of the lockdown really caught most of us off guard, but it seems like a repeat of history. But perhaps worst, because, you know, we are staring at a significantly higher number of COVID cases. So how should one brace themselves for this?
I think liquidity is king right now. Cash is king. And, you know, many were caught unaware in the first lockdown. So I think it's very important to have enough liquidity created. Have an emergency fund which is extendable to almost 12 months, because we're hearing a lot of people even losing their jobs. So I think that is another important point to keep in mind. And by default, I think since people are not moving out much, spending is anyway curtailed. So that's a positive on the cash flows of many. And I would also say this would be a good time from the investment point of view to consolidate one's investments, to close policies that are earning below inflation returns, to sell land which is not earning or under litigation. So I think this is a good time to even look at consolidation.
Okay, interesting. You know, before I look at investment strategy as well, I just want to get a bit of a more broader picture, a little non-technical, if I could call it that. Many of us last year were largely without something crucial like an emergency fund. When COVID came and many of us unfortunately saw pay cuts, lost our jobs, we didn't have a backup fund. Many did not have it, even though, of course, I'm sure you and all the personal finance experts out there have been strongly advocating that you have to keep out some funds, for a rainy day, either in a liquid fund, a savings account, or whatever it is. So how do you recommend that in a worst case scenario one should quickly spruce up their emergency fund, and what's the amount as well?
Right. So like I said, a good thing would be to try and consolidate. So if people have not been able to create enough liquidity, it would be a good idea to even rebalance one's portfolio, because markets had really moved up during the first phase of COVID. And that would create some liquidity for people through profit booking. Alternatively, just cleaning up or, having things in order, I think would also create, people would have forgotten about an earlier policy that they've purchased, which has actually been surrendered. So basically get in charge of your finances, have a financial planner to work out what is the best way to create that emergency fund, and have an emergency fund that's, at least 12 months extendable, especially if you don't have a spouse that's working.
Okay, let's talk about a little bit about investment strategy. Let's say if somebody, I know you sort of reiterated this in your first answer, but just for the benefit of our viewers, let's say if somebody believes that, okay, I may be, my business may be hit, as is the case, right? Because several retail outlets have been asked to shut down, or, I may once again be laid off, or I'll have a pay cut. From all the assets that one owns, let's assume they have a few equity shares, they may have some mutual funds, debt funds, a little bit of gold as well, perhaps. What do you think should be the pecking order of, what to liquidate to keep in that emergency fund?
Yeah. So I think obviously assets that are not performing well, like I mentioned, old policies that have given below inflation returns, or endowment or money back policies where the IRRs are very low. I think those are the first ones to fall upon. And then by default, considering profit booking on equity is another good, way to rebalance one's portfolio, bring the asset allocation in line with one's risk profile.
Okay, so basically, first up, look at those asset classes that are not exactly, performing very well, or it's something that you may have been any which ways mulling on really selling or exiting because you're not happy with the performance. So first, axe those, and then perhaps you can move on to some more assets. Hopefully, of course, the situation at your end may not be that bad, but if push comes to shove, maybe you can consider doing that. Now, another thing is that, the equity markets as well seem to be reacting to this COVID resurgence. That's at least something that we saw last week. As cases rose, there was a drop as well in the equity markets. What I want to know from you, Dilshad, is that many a times we see mutual fund investors as well reacting to this. Today, we had the AMFI data, which finally indicates that, after 9 long months of selling, mutual fund investors seem to be getting back into buying mode. But many of them were looking at this market rally as a place to sort of book some profits. So right now, what do you think an equity investor strategy should be?
Well, I think it's, you shouldn't take decisions that are short term and especially event driven decisions, basis, things like COVID, etc. Because when you have a strategy in place for, planning in terms of a strategic asset allocation, I would bring in a lot of, respect for that, because it has a certain idea or certain rationale behind creating that. So, interrupting that with any interim market vagaries is really not the right thing to do. So I think one must stick to their plan that has been laid out and follow that through to meet their financial goals.
All right. So, when you first up sit down with a financial advisor, to draft a plan, it's been drafted with a lot of care, with a lot of thought, and your financial advisor has already taken into consideration all the vagaries, the volatility that do come around with a risky asset like the equity market. So, when you're drafting, especially a long-term plan, do understand that all of these vagaries have already been accounted to. So it does not necessarily mean that you have to essentially react to every event-driven incidents or event-driven market vagaries as we are seeing happen during COVID-19. Imagine if you had sort of sold off before COVID struck the equity markets. You probably are getting a whole lot of FOMO right now. So just apply that as well into the current situation, and ensure that you are in, especially if you're a retail mutual fund investor, you're in it for the long term. Dilshad, let's talk about, since we're talking about personal finance as a whole, I wanted to actually ask you about insurance as well. We've been talking about this. Yesterday was World Health Day as well, and I'm glad to see that a lot of individuals have realized, it took a pandemic, of course, unfortunately, but individuals have realized the importance of a health insurance. So if you could stress the importance of, both the kinds of insurances, life as well as health, in the context of, the environment that we are in the midst of right now.
Yeah, absolutely. I think it really took a pandemic, like you said, for people to, be made aware of the importance of health insurance. And yesterday's data also has proven that sum assured has actually doubled from the previous year to the year when COVID started. So if the average sum assured in, a family was a 10 lakh floater, today the average has gone up to almost 20 lakhs. People have realized the hard way that it is very important to consider health insurance, especially independent health insurance if you are even employed by a company. So we, discourage people to depend on employer-provided health insurance for various reasons like group coverage, etc. Coming to the life insurance segment, again, here there has been a lot more understanding, a lot more acceptance, where people realize that they have taken term covers, for longer tenures. And especially people, I wouldn't like to generalize, but people in the IT sector have actually reduced the tenure of their premium payout because of the uncertainty in the job scene. So that has also brought about awareness about having sufficient amount of life, health, and a new category definitely which has grown is critical illness cover to a large extent as well.
Okay, understood. Talking about market vagaries and volatility, what would you recommend those individuals whose goals, for the purpose of which they had been investing in, mutual funds or debt funds, are coming closer? It could be retirement, but it could be something more pressing. For example, maybe a big payment for a home or for a new home, or maybe for an education that may be coming up. When you stare at such movement in the markets and the COVID cases, and you don't know, you never know, of course, that what the market is going to do next, it makes you a little bit nervous. So what do you recommend those individuals do right now for those whose goals are coming closer, who may be coming up in the next 1 odd year?
That's a good question, Mabina. So it's important that before any goal is realized, at least a year before, adjustments are made in the portfolio, to cater to the required value of that goal. And the best way of doing this is by moving the funds either into an arbitrage investment, which is more tax effective, or into a liquid investment such that the volatility is kept to a minimum, so that the amount that is actually required for that imminent goal, which may be 6 months or 8 months or even 3 months away, is easily liquidable and available at the fair market value.
Okay, understood. So, Dilshad, just, if we have to wrap up, what have been the most common questions your clients have asked you in phase 1 of the lockdown? And now, as we perhaps are staring at much more volatility and uncertainty, what are the questions that they're asking you now?
So I think there has definitely been a better understanding and acceptance of financial planning, more so in the youngsters. So initially there were the millennials who never really looked at long-term goals like retirement, but that has caught on big time in the pandemic. Spending has been curtailed to a very large extent, and eating out and, clothing expenses, etc. All that has reduced a very large extent. Vacations have reduced a large extent. And what we've also noticed is people are, wanting to consolidate, wanting to get in charge of their finances, wanting to know what exactly are those numbers if they were to retire. So people, for example, who are planning to retire 5 years from today have actually advanced their retirement because of such uncertainty, because of the fact that they don't know if they would be able to continue working for the next 5 years, given the certain, uncertain conditions that we live in today. So a lot of rework, a lot of rejuggling of portfolios have been done to ensure that they're able to have a comfortable retirement.
All right. And finally, Dilshad, if we have to wrap up the mistakes that we made from a financial perspective, from just an overall perspective last year, and the lessons that we should implement, God forbid, if a similar situation arises, what would they be?
I think the first glaring kind of learning would be to take adequate insurance cover. Both in the health and term insurance segments. And like I said, independent of the company provided covers, to also be financially aware of where you are in terms of your, financial situation today. So you obviously discuss with your financial advisor, these are the, goals and basically to understand what percentage of my goals have I met? Where am I today? Am I able to, ensure that I'm able to sustain a standard of living that I would have today post-retirement? So these are the questions that, people have been asking in a more serious way. And I think definitely the emergency fund is something that, so we used to include the emergency fund for all our clients, and sometimes wonder why. But I think this pandemic has brought about an understanding of why and the rationale of doing that for each of our clients. So, and more than an emergency fund, also a health corpus fund, right? So things are not covered sometimes under health insurance. So you need to have an independent health cover corpus like outpatient expenses or cataract or other operations which are not typically covered in normal health policies, which are considered as exclusions.
Understood. All right. Well, there you have it. And I hope our conversation would sort of equip our viewers to deal with this in a better fashion, definitely better than what they did last year. And I would recommend that all of you proactively as well consult your financial advisor as well, to better deal with all the uncertainties that we are facing, which may, of course, reflect on your financials as well. Well, you know what, I think at this point I would like to now throw open the floor for our viewers as well and ask them to send in their questions for you, Dilshad. So if you would like to ask her any questions, any follow-up questions on all that Dilshad has said so far, you can write in to us. Our email address is themoneyshow@etnow.tv. Well, let's take on board some questions that we already have received. We have Raghu writing in saying, I depend on fixed income. I have put 50 lakh rupees in fixed deposits which yield 5.5% return. Now he wants to know, how can I get better income through other products? I'm yet to reach the age of 60. Okay, so for whatever reason, he does not like investing in, equities or other so-called risky assets, and that's why he just prefers the plain Jane FD interest, which, gives you your return in black and white. However, I think now he's sort of looking at other products because, of course, an FD yields barely 5.5%. So Dilshad, where would you get Raghu started off? And mind you, he doesn't exactly have time on his side because he's yet to reach 60, so I would presume he's at least 55 and above.
So I think definitely maintaining a conservative profile is important, but the particular asset of fixed deposit that he's chosen is not going to serve the purpose of a regular income that he requires. Ideally, the analysis of various strategies in the distribution stage of retirement, starting from, SWP on debt funds to annuity options to dividend to, of course, he's not yet 60, but then you have the senior citizen when he enters 60 RBI bonds, etc. So these are the various options and categories that we would need to evaluate and work out the best post-tax return option and then suggest the way forward.
And yeah, one thing is for certain, that don't even think that this money is going to sort of help you sustain post-retirement. It's not going to cut it. You'll have to sort of amp it up. And I hope this is a lesson for all our viewers. Okay, Tushar Vai asks, after the Monetary Policy Committee, does it still make sense to stay invested in the HDFC Money Market Fund for 6 months, which he has invested in for his daughter's education fee? Further, he also says that he's invested in the ICICI short-term debt fund for 2 years for a certain one-time expense that he will have to pay for 2 years later. So I'm glad he's, sort of reading the papers and seeing how all of this impacts his money. This is a session that we as well had yesterday with Devangsha. So yeah, Dilshad, what do you think of these two assets that he's invested in, clearly for the short term?
I think if his goal for education expenses of his daughter is coming up in 6 months, liquid would be a good option, and that's fine. Looking at the 2-year time horizon, a short term. So typically, one would decide the instrument in debt by looking at the YTM, by looking at the maturity, profile of the various instruments, and trying to ensure that the maturity profile and the tenure of their goal matches. So that is when a perfect kind of, I would say, a synergy happens in terms of what you're investing. So as of now, what he's done is fine. It's just that he must consider that both these would be considered as short-term capital gains and would be taxed as per his tax bracket. So he must be aware that, the amounts would be fully taxed, on the gain part of it.
Let's then take on board one more question. We have Satish writing in saying, I'm 32 years old. I have multiple goals. I have assets in equity and debt, which is on 50-50 basis. He has the UTI Nifty Index Fund, Direct and Growth Plan, Post Office PPF, Post Office FD for the debt part. Should I add another fund or increase asset equity allocation? Pardon me. So that's all that he has. What would you recommend he do? Because he just has one index fund in his portfolio right now.
Yeah, I think at his age, he can definitely, take on more equity, especially if his goals are more than 5 years away, and considering that the markets are likely to do well in the next 4 to 5 years. So I think if his kind of allocation is 30% towards equity, he can ramp up, up to almost about 60, 65. However, we would need to understand his risk-taking capacity, his risk profile, and then provide for a proper suitable asset allocation and a portfolio thereon.
Well, there you have it. That's, of course, Dilshad's view on Satish's question. Not much in terms of asset allocation, so he'll have to broaden the spectrum for sure. Dilshad, I think with that, we are out of time, and that's all the questions as well that we'll be able to take. Thank you so much for joining us today.
Thank you for having me, Rubina. Thank you.